We won't after that. Thanks everybody for being here. The December WITI Link SV
Tech, talent, and
technology trends.
investment trends.
Yes, thank you. See, you had it right up there for perfect timing. Amazing how much was 18. Well, we're gonna hear, but I don't want to. I've been reading all the newsletters you guys have been sending out, Don, and pretty crazy what's been going on. So I know you have a lot to go over. I'm kicking it right to you.
All right. Thank you so much, David, and glad to see everyone here. Hope to see a few faces from the event I spoke at last night. I went over some of what we're going to go over today, but not by all of it. So November, we're almost to the end of the year. November was another record breaker. Oh no, I have to get into present here. And I have to move this out of the way. Excuse me for just a moment. There we go. All right. So November broke records for November in general, which usually is quiet after about the 10th of the month because everyone's prepping for holidays. Not this month, or not last month, excuse me. We're already above 180 billion as compared to 2021's previous high of 123 billion. The only question is how much higher we're going to get before the end of the year. I would expect it to slow down maybe after this week in preparation for Christmas, but I don't know. All bets are off. Thanksgiving really didn't slow down for much more than 2 days. So let's break down a little bit more here and look at where that money went. Come on now. Oh, why isn't this? All right. So a little bit of breakdown on the different areas that the investment went into. No surprise that 84% of that 18 billion went out in mega deals. Mega deals being 100 million or more to a single company. Most of those companies were AI companies or applied AI companies using AI in a horizontal enterprise focused application. So, 10.13 went out to AI, infrastructure, applied AI. If you look at infotech and software, a little over $1 billion. Fintech walked away with a really good chunk this month, 1.51 billion. And past that, it was broken into, quite frankly, 3 times the number of segments you see here. They're just small enough as compared to the AI area that they don't show in detail. Lots of mid-stage and late-stage funding that continued to flow. Biotech came back with a couple of big rounds in November. Let's go on from here. And one of the things that really stood out in November was the AI valuations just continuing to go up. And this is not limited to AI infrastructure, but it certainly is personified by AI infrastructure. Now, OpenAI closed their last round within 3 months of having a 350 billion valuation. They did a secondary round for their employees, for investors who wanted to get some liquidity. That was at a 500 billion valuation. And in the press following that, they floated the idea they'll be doing an IPO 26, maybe 27, and gee, likely a $1 trillion IPO, largest IPO ever. Sam Altman likes to pull press, and he's very, very skilled at doing it. But Anthropic is now competing in this arena. They closed a round 138 billion valuation. That was for 13 billion in October. They are now actively raising maybe as much as 200 billion more, but it's at a 300 billion valuation. This is 30 days, 40 days, so 50 days since their last bump. And Anthropic also alluded to the fact that they are positioning now for an IPO. They've hired an investment bank to guide them, and some legal talent in that arena. And they hope to IPO sometime in 26. So we've got a little bit of a horse race between OpenAI and Anthropic, which is interesting because Anthropic has really, up until just recently, been very quiet, focused on being the safety AI. And right down the line, Thinking Machines is now raising again after they got a 12 billion valuation for their 2 billion seed round. They've got a beta product out. They're raising again. They want a $50 billion valuation. And the last one I'll mention here, Harvey. Harvey closed their fourth round yesterday. 160 million, 8 billion valuation. That's up from 5 billion and 3 billion, both of those previous valuations this year. So when I say this isn't limited to the AI infrastructure arena, to some extent, the practice of pushing for higher valuations absolutely filters down into the smaller AI infrastructure companies, into the applied AI arena, into almost any company doing AI. And it's a very strong influence on the just steady drumbeat of valuations rising. Let's go on from here. I'm dwelling on this again this month. I talked about this a little bit last month. We're going to talk a little bit about the circular deals, the web that's being created between all of the key companies in the AI infrastructure arena. And you now really have two groups in the opinion of looking at what's happening and coming up with opposing opinions. One that, yes, we're in an AI bubble. These valuations are absolutely bound to crash. They cannot continue to rise. There is not a corresponding intrinsic product revenue value to match what's being placed on the company valuations. On the other side of it, you will hear that this is not a bubble. It's going to continue to increase slowly but steady because we are so early on in the AI wave that we really don't understand now the immense value that's going to be created over the next few years. And we're not even able at this point to reasonably do the equations to come up with the reasoning to validate what we see for values right now. But again, the attitude there is, no, we're no bubble. It's going to continue. I put this graphic up last week just to emphasize OpenAI in particular has gone two extremes in ensuring that at least the roadmap and the contracts, the commitments, the agreements, the partnerships are in place to create what they believe is going to be needed to supply power and compute over the next 10 years. And it's a massive number. They're looking really at more than 100 gigawatts increase over where we are now. Something along the line of 500, at least 500 billion in infrastructure cost on an annual basis. Well, if you look a little bit further at the interweaving of investment, purchases, commitments between Microsoft, NVIDIA, Anthropic, OpenAI, Amazon. I don't even have Google on here, and they should be on here. I just ran out of room. Not to mention crisscrossing lines. Everyone's tied up together. If for any reason OpenAI did not complete their commitments, you would have a domino effect that would certainly hit at least 3 of these other companies. Now, you can say that Microsoft and NVIDIA are certainly big enough to stomach anything that happens to OpenAI. It's the smaller companies around OpenAI that probably would take the hit. But right now, these circular contracts, and when I say circular contract, I simply mean, as an example, over on the left, Anthropic commits to buy 30 billion in Azure cloud services for Microsoft. Microsoft agrees to invest 5 billion. NVIDIA agrees to invest 10 billion. Anthropic, of course, is going to buy NVIDIA processors. Microsoft is going to buy NVIDIA processors. Virtually everyone working in this arena, with the exception of AMD, is going to be buying NVIDIA processors. So you could also make the argument that NVIDIA is at the center here, but there's no question. We have lots of cross connections and potential vulnerabilities between these companies. So I want to move to M&A because in our last talk, and really, really high on trends for 2025, is that exits have returned to at least a small extent. And of course, exits are absolutely critical to returning money to the Valley, investors to start new funds, LPs to make new investments, new entrepreneurs to start new companies. And we have been just an absolute desert for 3 years in terms of exits and money coming back in and liquidity in general. So this year, M&A really took off. And actually, when we total up exits overall, and we'll look at IPOs next, but exits overall in the first 3 quarters of 2025 matched the full year 2021. And to contrast that, that's a little bit more than the combined exit value for the last 3 years. So that's how dry it's been, and that's why it's looking so good. So lots and lots of acquisitions. Totals here, it's like 430 acquisitions, only 68 of which disclose the price, and the total overall of disclosed price was around 238 billion. But not all acquisitions are even. There are acquisitions that make a real difference, and that's the ones that are $1 billion or more. Opinion before this year had been that we simply don't have enough big companies with big enough checkbooks to make a difference in $1 billion acquisitions. And we sure saw a change to that this year. Q1 was slow. And this is true for IPOs, it was true for M&A, it was true for a lot of business activity. And it's largely because of uncertainty. What was going to happen with Trump, the tariffs, overall economy? When there's uncertainty, business just doesn't move forward. Everyone halts and waits to see what's going to happen. Q2, I'm sorry, there was one outstanding in Q1, and I've actually added it back in. We thought it was going to not go through. That was Google buying Wiz. Now, Wiz is a security company back east. So it's actually, well, it may not sound like money coming back into the Valley. The Valley VCs, virtually any big venture-backed company anywhere in the country will have significant exposure with Valley VC. So a lot of the 32 billion that Google will pay for Wiz will come back here to one or more of our VCs. So that was the one big one in Q1. Q2 expanded 126, $8 billion plus acquisitions. Now Q3 was the really barn buster. Had $10 billion acquisitions, one of which was 55 billion. That was for Electronic Arts, being sold to a combined VC and private equity group. But overall, that returned those acquisitions, 10 acquisitions, will return 126 billion into pocketbooks around the country, a lot of them here in the Valley. And Q4 has not slowed down a lot. We've had more undisclosed acquisitions, fewer billion-dollar acquisitions, but still lots of activity. So overall, right now, 215 billion just out of these billion-dollar plus acquisitions. And that is enough to move the needle. So that has been really, really good news. Okay, IPOs. And I'm not stopping, David. I expect you'll holler at me if there's anything that we should answer.
Yeah, I'd say if somebody has a question, we could do some little Q&A at the end.
Okay, sounds good. So just two things to point out here. The red, pink. Anyways, the shaded items over in the IPO valuation and pre-IPO valuation column are the IPOs that went out this year at a less than their max value. All five of those companies had big valuations back in 2021, 2022. And of course, 23, 24, everybody sank. Some companies have climbed back up and above, some haven't. And these five chose to IPO and just took as a given they might not hit their previous valuation. But out of these IPOs, there were two in particular that were really good news. That's the bolded billion to one for biotech and Figma for tech. Why were they really good news? Because they came out, they popped, they saw a lot of interest, a run up of price, and they're still doing fairly well. Public market always has ups and downs, but those two sort of set off additional companies deciding to IPO until we hit the shutdown, and that sort of slowed things down. But overall, we are looking forward to a better year next year, because next year you should see some AI companies IPO. Figma, not really. It's a tech company, but it's not an AI company. If you look at CoreWeave and Circle down at the bottom, both of which are, well, one crypto, one AI, both have done very, very well. And CoreWeave is really our best indicator of the appetite in the public market for AI tech. And therefore, we are looking forward to a much stronger market in 2026. That doesn't mean we're going to go back to 2021 arena in which we had literally hundreds of IPOs. We still have a lot of companies that are private. As a matter of fact, we have more companies private at a greater total value than ever before. It's something around just under $3 trillion. 100 of those, 100 plus of those have already filed for IPO, but just haven't chosen to exercise that option yet. On it's a flip side, the secondaries, which are offerings of private market stock to investors, to anyone who wants to get a piece of a hot private company before they go public. Secondaries are still going strong. There's now about 8 billion in dry powder funds, which is, VC funds that are waiting to be invested. And that means that there's ability for employees, founders, investors to cash out if they need to, if they want to. And that option is always a good thing to have. It does mean that some companies will choose to stay private longer. That's open as an option to them as long as there isn't undue pressure from employees, from investors, and there's money they can raise in the private markets. And right now there's a lot of it. We have one more company to go in 2025. Wealthfront did file the 2nd of December. Very unusual time to file, but they did, and they're going to, it's 20 days after they file to hit the public markets. So that's going to happen just before Christmas. And the other thing that's hanging out there that could potentially incent more companies to go public is that the head of the SEC has floated reducing a number of the regulatory requirements, both to go public and as being public companies. So all of this together, we think is going to lead to a stronger market next year, more liquidity, a little bit more health coming back into the valley. That's just about it. Let me just do a quick roundup on Link Silicon Valley. All of this detail, the figures, the companies, the information. We call it business and funding intelligence on the Silicon Valley startup ecosystem. We put out a weekday newsletter, Pulse of the Valley. It is roundup fundings, exits, M&A IPOs, also the investors. Who's moving where, who's raising new funds, who's closing existing funds. All that information that goes into the Pulse also goes into our database and is available for service providers who are looking to do campaigns, looking for particular companies of value. And quite frankly, most value is to entrepreneurs raising money. Since we can slice and dice and look at particular segments of companies, we can see exactly who invested. You can see the executives that got that investment, and most of those folks' profiles have email addresses for contacts, LinkedIn connections to see how to get to them. So that's all good stuff. We have an entrepreneur membership. We want to do everything we can to help entrepreneurs be successful. So what we put out for $50 a month is available just $7 a month to entrepreneurs. And we do a fundraising webinar once a month. We'll be posting up on our LinkedIn page when and where. And we have added on one new thing recently. We're now helping you connect with some trusted outsourced developers that we vetted if you're in need of development resources. Okay, David, thank you so much, and I will hand it back to you.
Thank you, Dawn. And then yesterday, Netflix buying Warner Brothers was pretty big.
Pretty big.
Rising news, I think. Yeah, I mean, I heard a lot of different places it may go.
I've heard a lot of different things that may happen as a result of it, so we'll see.
We're just starting. I do like their AI-friendly environment at Netflix. Would anybody like to have any questions before we go back?